How's it going, guys? Steve from Broke to Wealthy. I hope you've all had a beautiful week. In today's video, I'll be breaking down the difference between value and growth stocks, and I'll be showing why it's important to have a little bit of both in your portfolio so that way you can manage your risk. We'll take a look at two ETFs. You know, I love ETFs. We'll take one that is growth based, and then we'll take a look at an ETF that is value based. And because I'm so convinced on these ETFs, I will be buying a little bit into each on today's video. So let's go ahead and jump straight into it. Alright guys, let's take a look at the difference of growth versus value. Now growth is going to be more of the riskier side of investing. If you're an investor that wants more of a safe, a secure type of style of investing, then you're going to focus more on the value stocks. Now growth stocks, these are your revenue increasing substantially higher type of stocks. So these are your Teslas, these are your Googles, your Amazons. These they cash cows essentially. They are positive in cash flow. The thing about the growth stocks is they will usually have what's called a PE ratio, a price to earnings ratio. They'll usually have a higher PE ratio, and what this means is that the company is overvalued. So it may be getting a little bit ahead of itself essentially, and that's why people see it as a growth stock, because it's growing to catch up to its PE ratio. So for example, now Tesla has the highest out of the 10 most valued companies in the world. Tesla has the highest PE ratio, and which says that Tesla is overvalued, and people are willing to bet by buying shares in Tesla that they are going to bring down that PE ratio, and the company is going to get more and more valuable over time and essentially grow it as it moves along. So that is what a growth stock is. These are high quality, successful companies, and like I said, they are more volatile. Then on your other side, you have your value stocks, your snooze stocks, your boring stocks. These are usually perceived to be lower than the value of the company, so they'll have a lower PE ratio as opposed to the growth of the high PE ratio. So basically, these stocks could be seen as undervalued. So these are cheaper stocks, and that they have that value that people see. They're willing to put money into it because they know that it's cheap and it's going to increase in value over time. So the common thing with value stocks are that they do have dividends. Most of them will have at least some type of dividend, and that is able to give you basically what dividends are. It's giving the shareholder a reward, a return on the investment in the form of money, and basically for saying thank you for holding the stock, and I'm going to pay you back a percentage of the amount of stocks that you owe. So if the stock goes up, and you're getting your capital gains on the stock going up, and then your dividend is coming to you as well. Some companies will pay monthly, quarterly, biannual, so there's all different types of dividends. These are also high quality, successful companies, and of course they're going to be less volatile. So these are growth stock examples, and this is kind of like a growth stock example chart because it is very volatile. So if you got your Googles, your Amazons, your Tesla, your Meta, Shopify's, high PE ratios, these are stocks that have large fluctuations on, very more risky than the value side. Value stock examples, like I said, boring companies. These companies have been around for a long time. They know what they're doing. They're paying a consistent dividend that's increasing over time. And these are your Coca-Colas, your Procter & Gamble's, Johnson & Johnson, NextEra Energy, which is the owner of FPL, Florida Power and Lights, and then you got Kellogg's. Boring companies, pay a dividend. They kind of slowly, I didn't put an example of a chart on here, but it's kind of just a steady increase over time. You're not going to have those large spikes in the charts. And these do well in a down market. So right now, during the time where the markets are down, your value stocks are the ones that are doing well. For example, General Mills, the company that makes cereals, they're kind of like Kellogg's. They make all types of snacks and foods. They just recently hit an all-time high in their share price this week. So with everything else like getting hit and all these growth stocks down like 20-30% for the year, you've got a value stock like General Mills that has just hit its all-time high. So people seeking value in these down markets to put money in and to protect their wealth. Let's talk SPHD. This is the first ETF, and this is the value ETF. You can see its value because it says high dividend, low volatility. And I love this ETF because it pays 3.9% dividend and it pays it monthly, which is excellent. And so how this one works is it basically breaks it down here. They've got 21% of this ETF is made up of utility companies. I love utility companies. People are always going to be looking to pay for shelter, food, clothing, transport, and then lights and water. So your utilities are going to be consistent, receiving money, receiving revenue, and they're increasing their prices, which like they just did with our lights. So they're increasing their prices, so they are also able to get increased revenue. So I love utility companies. You got your healthcare, energy, financial. So it's got a good round value play. You're going to see in these value plays, there's a lot less of these technology stocks. You're not going to be seeing so much of Apple, Amazon, Google, Nvidia, and all that. And because it's not in this one, it's going to be in the other ETF that I'm going to show you right after we get to taking a look at SPHD. So how convinced am I on SPHD? I am extremely convinced that this is a great play on a safe value ETF. This is my personal opinion, thinking that this is a great play on a safe value ETF. If we take a look at the 5-year chart, we can see that obviously it's only gone up 9% over the past 5 years. So 9%, it's not a lot. Again, it's a value play. This is paying you a monthly dividend. This is income. This is income coming in every single month, and that is why it is not an explosive growth like the growth stocks, right? So we had the huge COVID drop right here, which was a great buying opportunity. And then over here again now with the recent downturn in the market, it is went from 48 and it's now at 44. So again, not designed to go to $100, $200, but designed to pay you a consistent monthly income through dividends. Okay, so right now I have $5,000 in this, and because I'm so convinced, I want to go ahead and let's add $900, and we want to do a market order, review order, and let's buy. Okay, and because it's still under that $48, I still see it as a good return. Let's just update this here. I think just got to refresh it. Why is that not updating? There it is. Okay, cool. So we just went ahead and added that to our SPHD. The other one, now this is the SPYG, and this right here, this is the growth ETF. Okay, so this dividend, I think it has a dividend, and it's going to be paying you a very little amount as opposed to the 3.9% on the value. This one is paying you a 0.88%. Okay, and I believe that's quarterly. That's not even paid monthly. So the difference with this, obviously, take a look at that right there. 41% of this ETF is made up of technology stocks. All right, Apple, Microsoft, Amazon, Alphabet, which is Google, Tesla, Meta, formerly known as Facebook, Nvidia, Eli Lilly, and Home Depot. So instead of you having to buy just individual stocks, now you could buy one SPYG, and you can own a piece of these companies, right? And that's not even all the companies. That's only half of the assets. So you can essentially own all the other companies that are in this as well. So let's take a look at the chart on this one, and over the 5 years, boom, that is a growth chart right there. You're gonna see that large increase, 84% over the last 5 years. So capital gains coming through, but no dividend. So that's where you see the difference between growth and value, right? So let's take a look at where we are right now. And before everything started tanking, this was at $72 a share, and right now it's at $54.79. So this is a great buying opportunity. It's a lot cheaper. It's still got about $20, $18 to go before it gets to back to where it was before this downturn. So I'm convinced that let's go ahead and put $900 into this and buy 16 shares, review our order, and buy. Perfect. So we just went ahead and added $900 of SPYG, which I think is a great over time investment. Thank you guys, that has been today's video. I hope you got value out of that. Be sure to hit the like and subscribe button. In next week's video, we'll be diving back into our Beyond Wealth series and look at other areas of our lives where we can increase our wealth. Until next time, keep your head in the game, look after each other, and I'll catch you on the next video. Cheers.